Hello, I'm Jessica Amir for the Finance News Network. Today I'm with Karara Capital Investment Manager Andrew Smith. Andrew, welcome to the network.
Hello, thank you.
Thank you very much for your time today. So for those that are unfamiliar, Karara Capital specialises in Australian equities. So what's new and exciting at Carrara in 2019?
Well, something that's really exciting we've been working on for nearly 3 years now is our market neutral fund. And we're bringing that to market in a retail version, and that's really exciting. These sort of funds are really new to Australia. They've only been around for about 4 or 5 years, and there's not many people in the competitive landscape. So we feel as though we're leading edge and getting to market early.
Thanks, Andrew. And turning to the 2019 May election, what can investors expect?
We think there'll be more uncertainty for investors. So there's 3 sort of categories that we were concerned about. One is negative gearing, so the prospective changes that will disrupt the market, so could impact residential pricing to the lower side. We're also concerned about the prospect of implementation of the Hayne Royal Commission. So that's, if you remember, that's to do with the banking. And if they force that too quickly, all of the changes, it may put pressure on the banks, and they will in turn lower the level of credit they'll lend people. So simply that means there's not as much money available for mortgages. That puts further pressure on residential. So making these changes too quickly could really hurt the residential property market. The final thing we're worried about is industrial relations. So that implies wage pressure. We've already seen this week Chemist Warehouse came out and had to increase wages by 20% over the next 4 years. And that might be a signal of things that are about to come in the future.
Now to your investment offering, Andrew, just walk us through your process.
Well, market neutral is a bit different to other funds. I need to explain straight away that, for an example, $100 long and $100 short means we've got no market exposure. So that's interesting. The targeted returns that we're going for are somewhere between 9 and 12%. And importantly, the volatility that we're looking for is only 4 to 8%. In context, the equity market's 13 to 15%. So it's much lower volatility with very strong returns. We've been rated by Australian Ratings as an approved product. And also our performance has been really strong.
Now, can you just dive down a little bit more deeper into the fund?
An example for a current position is long Spark Infrastructure and short AusNet. They're both Australian electricity transportation and distribution companies, so they're pretty much the same style of company, and that's what a pair is. Long one we like, short one we dislike. And we only dislike and like based on relative valuation, so that changes. Another great example is Coles versus Woolworths. Currently, we're long Coles and short Woolworths. The principal reason is that the valuation differential is huge. Coles is trading on a forward multiple of 16 times and Woolworths is on 20 times. So there's about a 20% relative value differential, and we think that's wrong. So in this fund, we've got the opportunity to go long Coles and short Woolworths. And as the shares move, we make the difference in between. And that's, in a nutshell, what a market neutral fund does.
Changing pace now, Andrew, and turning to the US, we saw a key recession indicator rear its head for the first time since 2007. Just tell us what occurred and what it means.
There's so many distractions going on, things like Brexit, Trump texts that come out in the middle of the night, but something we can hang our hat on, and it's been proven in the past as a recession indicator, is the changing shape of the yield curve. So in simple terms, the 10-year bond yield is normally higher than short-term bonds, and that's a normal curve. What's happened is the long term has declined, and it's actually gone lower than the near term, and that's historically been an indicator of recession. It's not a guarantee, and what we've looked at in our study is that generally it has to be negative for about 3 months, and if that's the case, a recession can come and equity markets treat that very harshly. In the last 2 times it's happened, the equity markets have fallen 50%. Now I know that's scary, it's not necessarily what I'm saying, I'm just saying a warning sign has gone off. So for asset allocation decisions, it's really critical at the moment to be careful of your equity exposure. And I might add, a market neutral fund, which doesn't have any equity exposure, is a really nice place to be at this time in the cycle.
Well, there's absolutely a lot from us to take out of this interview, but just lastly, before we let you go, anything to add today?
Well, there's been 2 really surprising things going on in the market. Probably in the last 6 to 12 months, it's surprised a lot of professional investors. So not just normal mum and dad investors, I'm talking about guys who've been around 20 or 30 years. One of those is the phenomenon of high PE stocks, momentum, versus low PE or value. That dispersion has gone out to the widest level it's been since 1999, the tech boom. We know how that ended, it wasn't very pleasant. So that's occurring right now as we speak, and it's hurt a lot of performance from a lot of managers. The other thing is people trying to predict bonds, And that's why previously we've spoken about the inverted yield curve, but predicting these bonds is really problematic. You go back 6 months ago, many prominent Australian investors who've had long-term successful records were saying the Australian bonds were going to go to 3.5% to 5%. Now they've actually gone to 1.7%. So work that out. It's very hard to predict. So that's why I fall back to the yield curve inversion being a real red flag for the equity market.
Well, Andrew Smith from Carrara, thank you so much for your time at the Interprac Financial Planning PD Day.
Thanks for having me.